Health savings accounts finally allow us to do what we've always wanted, legally avoid paying taxes, at least on eligible healthcare expenses. For 2013, the IRS is allowing us to save a maximum of $3,250 for an individual and $6,450 for a family of 2 or more annually, tax-free. Sounds good, right? There are generally 3 ways to fund a health savings account. Most common is pre-tax through payroll deductions. This option can make contributing to your HSA very easy, since the money comes straight out of your paycheck pre-tax, which lowers your taxable income and reduces your tax liability. If for some reason your employer does not offer contributions through payroll, or you would simply like to add supplemental funds to your account in order to take advantage of the tax-free interest you'll earn in your HSA, you can do so by contributing after-tax dollars. But don't worry, you'll still get many of the great tax benefits. Since you've already been taxed on these funds, you would take an above-the-line deduction when you file your taxes for the year. I know this can sound very confusing. Let me see if I can break it down for you. Above-the-line deductions adjust your gross income, meaning if you earn $40,000 this year and you contributed $1,000 to your HSA, then you would only be taxed on $39,000. How great! Lastly, contributions made by anyone else. In some cases, your employer may choose to contribute to your HSA account. When this happens, the amount contributed is excluded from your gross income and therefore is not subject to income tax. Who else can contribute, you ask? Actually, anyone else that would like to. Mom and Dad may feel a contribution to your HSA is the perfect birthday present. And here's the cherry on top. The money that is put in after tax by anyone other than your employer is tax deductible to you. So using the same example as before, if Mom and Dad contribute $500 on top of the $1,000 you've already put in, you would only be taxed on $38,500. Even better! There are a few things that are very important to remember about your health savings account. Even though the money is yours to spend how you like, the tax benefits only apply to eligible healthcare expenses. This means that if money is withdrawn for non-eligible expenses before you reach age 65, you will have to pay taxes on that money plus a 20% penalty. After age 65, the penalty is removed. However, you are still required to pay tax. Also, make sure you don't get overly excited and contribute more than the IRS maximum. Any excess amounts in your account will be taxed as normal income and charged a 6% excise tax. Thank you for taking the time to learn about HSAs. We hope this presentation has been helpful.